Hi everyone. Thanks again for joining for our weekly discussions about the macroeconomy and the markets.
Yeah.
Abhishek, what's on your mind?
Yeah, thanks everybody for joining again. So Prachi, we were just talking about, you've been in academics for close to 2 decades now, and you there are these kind of colloquial things, right? Sell in May, go away,
Uh-huh.
Magic March,
Yeah,
Christmas rally.
yeah.
Are these things true? We are seeing just a tiny reversal of the market for the last couple of days, and somebody's even mentioning that this could be March magic. Apparently every March is magic rally. Is this true?
Actually, it's very useful to kind of just look at the data to see. There's a lot of talk about Magic March or
Hmm.
March Rally. If you look at the Indian markets, last 25 years, 13 of the March have a negative return and 12 of the March have a positive return, right? So roughly equal odds of up versus down, right? So at least based on the performance of Nifty 50, there is no basis in thinking that March is any special, right? But it's a very nice intuitive story to think that okay, there's a lot of spending that happens in March.
Yeah.
People want to exhaust their budget, so more consumers will come, corporate or individual consumers will come spend money, and that will boost the profits and hence the stock market, right? But market usually anticipates many of these things, and so there is no automatic reason that this should translate, and data also does not support a consistent idea of March rally more than just random chance.
Random chance. Yeah, I mean, 50-50 over a 25 sample period is basically random. So, but that said, I think there are certain, since we are talking about macroeconomy, like the factors are there, right? So March, all the government budgets will expire, which means either they spend it or they don't spend it, right? So they have to spend as much. So they push through spending in February, March. That's very important. This whole last financial year, there was elections, so government capex was subdued, which is catching up, and hence there's an accelerated capex in the last 3 months, which is important. There's a 1 lakh crore tax break which is available to be spent soon. So in anticipation of that, people might be leveling up their personal balance sheets, right? So there are certain factors which we can't ignore, and
But what is important, Abhishek is absolutely right. What are the factors that are relevant for this March
mm,
rather than just going with the idea that any March will give
correct,
you positive returns? And these are the factors that are very important in today's
correct. This
macroeconomic
this much,
conditions.
and spending necessarily does not mean better markets, right? It takes a lot of time for the personal spending to feed through in the economy, usually 3 to 6 months. Hence, those are, there might be some exuberance very early on if the early trends turn out to be right. So you have to be careful of that. But again, markets do not care about months, right? I mean, there is no seasonality aspect, which you can say that March में ऐसा होता है, February में ऐसा होता है. These are all empirical data which has no basis in theoretical economics. So it's hard to say, but at the same time, markets are more of a living, breathing thing. So they might have artifacts that have not fully explained by economics yet, right? So we have to keep both of these views in mind.
Absolutely. And coming back to government spending, right? You already talked
Hmm.
about um, uh, government spending boosting the
Hmm.
economy, and we saw that government of India is
Yeah.
planning to spend some 500 billion plus rupees additional budget
Yeah.
they are planning on spending. Globally, Germany is also planning to increase their
Hmm.
spending, right? And so that is a little bit of a good news in the eurozone, uh, and this is particularly important given the global
Yeah.
uncertainty, right? Coming out of the US, the tariffs and the wars and so on.
Hmm.
So if there is, if central banks and governments are willing to step in if necessary, that is a good sign for the global economy.
So recently, gold has been rallying, right? So
Yes.
so in usually in a expected strong economy, gold is not the first asset class to rally. So what do you think? What is happening?
I think this is like a flight to safety
Yeah,
type of behavior. We have seen also people moving money in US
yeah,
government bonds. So US government bonds and golds are typically two very preferred asset classes when there is a lot of uncertainty, when there are macro fundamentals are a little bit doubtful. So I think that is
yeah,
what
and
we
currency,
see.
right? I mean, all these are fiat currencies. Fiat in Latin means in faith, which means that there is no actual real asset backing these currencies. So anytime people lose faith in these currencies, the currencies are basically valueless. It's kind of how modern monetary economics is. There is no, your 100 rupee note is not equivalent to 100 rupee of gold. So if the paper loses faith, then there is no value to that paper. Similarly, in fiat currency, so maybe like early on, people are contemplating changes in how currencies are valued. It might take a few years. It might take, it might happen very quickly. But I firmly think that there is definitely a reset for currencies in the making, as a next financial crisis were to happen. Something like, why do we need a Hungarian forint or a Swiss franc? I mean, these are very small economies compared to what other economies are. The use of a separate currency, maybe they can join eurozone, they can join European currency. So it depends on how these things play out. Prachi, another asset class, crude, like
Yeah.
Red Sea blockade, crude prices going up. How does that affect India? I mean, inflation.
Correct, correct. Yeah, as a oil importer, anytime crude oil prices go up, it affects our import bill and
Hmm.
it affects inflation because I mean oil prices will feed into everything, right? Having said that, I think overall there is not a lot of concern about oil prices going very high
Hmm.
because now I mean the supply is quite
And
distributed
we are getting oil
globally.
from Russia, specifically for India.
Yeah,
So we have a separate deal, while others were busy sanctioning Russia.
and also US has been quite keen on drilling
Yeah, yeah.
and supplying. So in terms of global supply, also,
Hmm.
I don't see like a
A risk,
bottleneck.
a bottleneck. I mean, things we look at are volatility in crude oil prices, volatility in the bond yield curve. Basically, it's the difference between the 10-year US Treasury bond yields minus 2-year Treasury bond yields and the volatility of that measure. Then gold prices, overall equity volatility. These are usually inputs to a good asset allocation model. We can observe this. As of now, as we have been telling for the last few weeks, fundamentally we are very bullish about where the macroeconomic data stands as of now for India. And be it March or not March, there are definitely factors that could propel this rally even further. But at the same time, you have to be aware of these kind of geopolitical risks that are emanating randomly, and the tariff uncertainty.
Correct,
Yeah,
correct. It's definitely continues to be high volatility
yeah.
period because of all these global uncertainties, right? But coming back to
Mm.
the markets,
Yeah,
we have seen this week some like
yeah.
the last 7 days some
Yeah,
green shoots. So
sure.
what is your
I
thought
mean,
on that?
being long only investors, green shoots are always pleasurable days for me personally and many of my investors. So, I think what we see, Prachi, is that investors are cheering the abating of FII selling. That is definitely one factor, right? The incessant selling of the FIIs have kind of paused for a bit, because I think they have these yearly review cycles. They typically do all the transactions between Jan and Feb, so it's always known that around that time global asset allocators will move money. The second thing is, obviously, I think all the tax payments and the real estate payments are done for most people, so they have money in the hand to go back into the market.
But also I think many value investors are kind of coming in
Hmm.
because now they feel that the valuations are more reasonable. Investors who buy on the dips, they are also getting in. So I think that is also the other side of the demand for equities.
Yeah,
Mm.
yeah,
Let's take some questions.
yeah,
So every week we take whatever live questions
yeah.
come during our session, but also people who watch the episode later post questions in the comments, and then we answer those questions in the next episode. So let's go to the questions that came for last week's episode.
Yeah.
Abhishek, you
The
want to
first
go?
question is from Kiran Shinde, and he's asking, "Hello, why do bank offers less interest rate on FD, whereas NBFCs tend to offer you more interest rate? Is it safe to invest in NBFC bonds?" That's the question. I think, Prachi, my feeling is FD is the only reason you invest in FD is for the safety, not for the returns, right? If you want higher returns, it is better to invest in a kind of a mutual fund which invests in debt of higher yield than you individually selecting an NBFC.
Yeah.
So I think that's kind of the first answer.
Yeah. But also one thing to keep in mind, right? That there is always these NBFC bonds are always a little bit more risky than the FD or than Government of India
Yeah.
bonds, for example, right? And so this higher returns, higher rates are compensation for that, right? We saw this at the early stages of the pandemic, where Franklin Templeton had a debt scheme that
Yeah.
was investing in higher yield, very short term, higher yield bonds. And when a crisis hits, then these are the type of bonds, these are
Yeah.
the type of assets that get affected first. So there is a little bit of risk, and this higher return is usually compensation for that. Right? Having said that, investing in a debt mutual fund is a better choice than selecting bonds
Yeah.
on your own, exactly as Abhishek said, right?
I mean, I remember a story where my one of my friends, he had 40 lakhs of a fixed deposit with DHFL, and it was very clear that they were going under stress. So I did advise him to take the fixed deposit out. It took him a long time to liquidate it because obviously they were also resting mass redemptions. So typically, I would say that as an individual investor, it is just not our cup of tea to go and evaluate every bond that an NBFC issues. There's a lot of 500 pages of documentation that goes with a bond issuance, right? So just for the returns, that's if that's attractive, just find a debt mutual fund which has similar returns instead of buying one single NBFC bond.
And additional point related to this is, if safety is your priority, even among debt mutual funds, you should look at Treasury or Government of India uh,
Yeah.
bond based mutual funds.
Yeah, there's no default risk, but there's interest risk, so just
Yeah.
remember that.
Yeah.
One thing, so there's a question by Shitake Kaka. It looks like a anime fan, or I don't think it's somebody who from Japan, but so
We are
let's
so popular, Abhishek. We have followers in Japan.
yeah, no, I think we can't do much about Japanese economy anyway. So but so I was watching Amit Jeswani interview recently, and he said, "Do not buy winners of the last rally, even if they're trading at significantly lower prices compared to the 52-week high price." But why? What do you think? I think he's right. Basically, typically every broad business cycle has a sector leader, and the sector basically kind of becomes a laggard over the next business cycle because things are a bit overdone there. So that's kind of the off the cuff answer, but more thoughtful answer perhaps.
So it depends upon, these winners are over what period, right? There's well established pattern that winners over past 3 to 5 years tend to underperform over next 3 to 5 years. So this is kind of similar to this the value philosophy of investment. So winners over past 3 to 5 years tend to be overvalued in general. Again, this is like a very very simple average pattern, right? But this pattern could also be behind this
Yeah.
advice. So it's really important to see over what time period we are thinking about the winners, right? Over a short term, momentum generally tends to be a very strong
Yeah.
factor, 6 months to 1 year. But over longer term, reversal tends to dominate, and that might be the
Yeah.
reason behind this advice.
Yeah, and I think that's why active management is important. Like you cannot just buy the leading sector and forget about it. That also doesn't work, which is what I think he's also saying. Amit Jaswani is also an active investor. He's basically kind of saying that active investment and active selection of these versus winners and losers is an important job. Which if you don't want to do yourself, you basically hire somebody else to do it for you. It could be a mutual fund manager, could be an investment advisor, could be anybody that you think can do the job for you.
Um, do you
Any,
have?
yeah, live questions coming up. Sanket Kumar, I was very impressed with what you do. How do you generate so much alpha? What is your secret sauce? There's no secret. I think we just focused on something which is the most. We try to measure something which is subjective, which is reputation, and we have a lot of technology. We have a large technology team. We have our own data which we process to select small stocks based on the reputation of the board members by constructing our reputation score internally. So that's kind of the main thing, and then of course we do basic consistency analysis. I think quality and consistency, right? Somebody who's consistently high quality, that's a rare thing overall in the world, and especially in stock markets and so on. So if you find a way to measure consistent quality, I think that you really have a winner there.
Yeah, and just adding to that, so more broadly, we believe a lot in the process of selecting the portfolio, and we the idea is kind of review the processes and stick to the processes.
Mm.
And there may be ups and downs in the short term, but in the long term, the systematic approach
Yeah.
comes out on top. So that's my two
Yeah.
cents, adding to
I
Abhishek's
mean, at the
point.
end of it, see, that's where like anybody can give you a list of stocks. That's not the IP that we have. Our list of stocks is basically available with a lot of clients. What they can't give you, or what we try to generate is the conviction. And even at the best and the worst times, we keep holding some of the stocks that has given us a lot of return or has seen large drawdowns, as we saw recently. There's a question by Black. What are the key sectors or stocks should investors watch ahead of the upcoming Q4 earnings season? What are the expectations? I think Prachi, financials have been kind of are set to do pretty decently in the coming months, and the rationale here is really simply that financials are more domestic business, isolated from tariff wars, these kind of geopolitical risks. So I think people will find that as a sort of a safe haven, and given that financials have been underperforming, they might see some inflows, and hence my answer. What do you think, Prachi?
Yeah, yeah,
I think also precious metals like jewelry manufacturers,
yeah.
finishing metal finishing, quasi like somewhere between the value chain of finished products and core mining, like building materials in metal space. Those kind of stocks we see as very interesting going ahead. I think but I think yeah, I mean we this is our rationale, but we'll always have surprises. But thanks for asking these questions. It's lovely chatting up and talking about markets, which we really enjoy doing. And keep your questions coming, and we'll try to give you more researched answers. Yeah.
Uh, Absolutely. Okay. So please tune in next week, and please leave your questions. If you are watching this episode later, we'll take them up next time. Okay. Thank you very much.
Thank you very much.